Hello and welcome to today's video. I hope you all are doing great. You might have heard the stories where people say that the particular person lost everything in the stock and that causes us to hate or get away from investing. But that's only 10% true, as they lost money not while investing but through speculation in future and options, shortly called as FNO. Without the proper knowledge of the topic, long-term investing and FNO are two opposite poles. I want to disclaim that I don't get involved in trading in FNO now, but understanding the topic doesn't harm us. Future and options are derivative financial instruments that allow investors to speculate on the future direction of underlying assets or hedge against potential price movements. The word derivative might also be new to you. Let's define it also. Derivatives are financial instruments that are linked or derive their value from underlying specific financial instruments or indicators or commodities. In this video, we will define FNO and then discuss its types, take a closer look on how they are used, the possible risk involved, and strategies to mitigate that. We will end our discussion with taxation on the income earned through it. Let's start with its definition. A future is a legally binding agreement to buy or sell an underlying asset at predetermined price on a specific date in the future. The underlying asset could be a commodity, a stock, currency, or an index, or a bond. Investors typically use future contracts to manage risk and speculate on the price movement in the underlying asset. They allow investors to lock in a price for an asset and take advantage of the price movement in the future. On the other hand, an option is a contract that gives the holder the right, but not the obligation, to buy or sell an underlying asset at predetermined price on or before the specific date in future. The holder of option can choose to exercise the option to buy or sell the underlying asset at strike price or decide not to exercise the option and let it expire. Options are used by investors to speculate on the price movement in an underlying asset or as a way to hedge against the potential price movements. Future and options are traded on organized exchanges like National Stock Exchange (NSE) and the Bombay Stock Exchange (BSE). They are subject to margin requirements and the daily price limits. However, it's important to note that trading in these instruments carries high degree of risk and may not be suitable for all investors. In recent years, the Indian government has also set up several measures to increase transparency and regulate derivatives market. In India, derivatives exchanges are regulated by SEBI, Security and Exchange Board of India, which is responsible for protecting the interests of investors and ensuring fair and orderly trading in the security market. Let us see different futures and options contracts used in the financial market. Let's start with the future. It can be commodity futures, which speculate on the price movement in the commodities such as agriculture products, precious metals, and energy products. Examples include gold futures, crude oil futures, wheat futures, and another is financial futures, which speculate on the price movement in the financial instruments such as currencies, bonds, and stocks. Examples include currency futures, interest rate futures, and stock index futures. Now let's see option contract. It can be call option, which gives holder the right to buy an underlying asset at predetermined price on or before the specific date in the future. Put options give the holder the right to sell an underlying asset at predetermined price on or before a specific date in future. Options can also be used in combined. For example, using a call option to speculate on the stock price increases and put option to hedge against the potential decrease in the same stock price. In India, the stock's weekly expiry is on Thursday and monthly expiry is on month's last Thursday. Studying charts, identifying trends, and using indicators like moving averages, relative strength index (RSI), and Bollinger Bands can help identify trends, support, and the resistance level, and potential buy and sell signals for trading in FNO. We might discuss these techniques in future videos. Now let's move to the next part of video, discussing how they are used in financial markets. It can be used for speculation, in which investors can speculate on the future direction of an underlying asset. For example, an investor who believes in the price of gold will increase in the future can buy a gold future contract at a fixed price today and sell it at higher price in future. Similarly, an investor who believes that price of stock will decrease in the future can buy a put on that stock. It can also be used as an hedge against the underlying asset's potential price movement. For example, a farmer worried about price of wheat falling can sell a wheat future contract at fixed price, therefore locking in price for the crop. Similarly, an airline worried about the price of a jet fuel increase can buy a jet fuel future contract at fixed price. It can also be helpful in risk management by financial institutes such as banks and hedge funds to manage their exposure to various types of risk. For example, a bank can use interest rate swaps to hedge against changes in the interest rate or use currency options to hedge against changes in the exchange rate. It is also used as arbitrage to take advantage of the price differences in the different markets. For example, a trader can buy a stock in one market and sell a call option on that stock in another market, thereby profiting from the price difference thereby. Trading in future and options carries a high degree of risk. Let's discuss some of the main risks involved in the strategies. FNO involves market risk. The price of underlying asset can move unpredictably.
This can result in losses.
If the price moves against your position, one of the strategies to manage market risk is to use stop loss orders, which automatically close the position when the price reaches a certain level. It might also be a liquidity risk for particular futures or option contracts, making it difficult to enter or exit a position. This can result in significant price movements and potential loss. One of the strategies to manage liquidity risk is to trade in well-established markets with high trading volume. It also has volatility risk, making it difficult to predict future prices movement. This can result in significant loss if the price moves against your position. One strategy to manage this risk is using option limiting potential loss. Lastly, it involves leverage risk. Future and option contracts are often traded on margin, which means you can control a prominent position and with a relatively small capital. This can result in significant losses if the price of underlying asset moves against your work. One strategy to manage leverage risk is to use conservative margin levels and closely monitor your position. Now let's discuss how taxation works. In case of FNO, your income from FNO is considered business income and you will have to file ITR 3 for this. Now since you are reporting future and option trading as a business, you are also eligible to claim expenses from earning of your business like brokerage commission, subscription costs, telephone costs, interest expenses, consultancy expenses, the salary of people supporting the business, and the like. However, it is necessary to maintain a proper record of expenses and also any cost over 10,000 in cash are generally not allowed to be claimed. In conclusion, future and option can be powerful tool for managing risk and speculating on market price movement. Still, it is essential to be aware of the risk and consult a professional before trading. With the proper knowledge and strategy, investors in India can take advantage of these instruments to increase their returns and achieve their financial goals. That's all for this video. Thanks for watching. Please consider subscribing if you found this information helpful. See you next time. Nikhil Dhawan signing off.